In this video, let's compare three very popular covered call ETFs that everyone is talking about. They are JEPQ, GPIQ, and QQQI. All three funds follow a similar investment approach. They buy Nasdaq 100 stocks and pursue covered call strategy. This gives investors exposure to Nasdaq 100 upside and downside while withdrawing income with high yield. But the execution of covered call strategy is where things start to diverge for these funds. Depending on your retirement goal, one could be better than the other. And by the way, I'm not here to pump or trash these funds. My goal is simple: to give you pros and cons so you can decide better which fund suits your needs best. So with that, let's get the obvious but very important stuff out of the way. The Nasdaq 100 is full of growth but high-risk stocks compared to, say, the S&P 500. The upside from this is that the index tends to grow at a faster rate on a historical basis. Investors in JEPQ, QQQI and GPIQ stand to benefit from this outperformance. But Nasdaq 100 can also go into prolonged slumps with drawdowns much deeper than the S&P 500. That's its downside. Now, on to covered call strategy. Covered calls provide that valuable cash flow stream that investors in JEPQ or GPIQ and QQQI really value. If we look at the Nasdaq 100 average yield, it's very small at 0.5%. In comparison, the distribution yield from these funds range from 10 to 14%. So most of it comes from selling call options on Nasdaq 100. When you sell a call option, you receive that valuable premium income, but your upside gets capped. So when Nasdaq 100 rallies, all three funds will lag behind it. But when Nasdaq 100 tanks, that premium income will cushion that fall. So as a result, all three funds will not fall by as much. But they do and will fall. For instance, GPIQ historically captured 90% of the downside of Nasdaq 100. But when Nasdaq 100 rallied, GPIQ captured 80% of its upside. In other words, the fund doesn't fall as much, but it also doesn't go up by as much either. The rule of thumb for covered call funds is that their upside capture is typically lower than their downside capture. And what that means is that as Nasdaq 100 goes through a cycle of ups and downs, this will amplify these funds' lag behind their benchmark. So the best way and the best outcome for these funds forward is the sideways market, when it doesn't really go anywhere. That way, these funds like JEPQ, QQQI and GPIQ will get to keep their income and sometimes even beat Nasdaq 100. So the key thing to remember is this. These funds at the end of the day rely on equity for their returns, and hence they will be volatile and follow Nasdaq 100 path. So this doesn't make them a substitute for bonds in your portfolio if diversification is important. I will talk about their performance in down markets shortly in more detail. Let's quickly look at the summary table. All three funds distribute income monthly. We see that QQQI by NEOS is the most expensive one. At the same time, it offers the highest yield at 14%. As expected, all three ETFs go heavy on the tech sector. Let's start by looking at JEPQ. JEPQ doesn't always hold Nasdaq 100 stocks one for one. JP Morgan uses proprietary models to select stocks from Nasdaq 100. The goal is to generate a better risk-reward profile. On average, JEPQ may deviate from its benchmark by about 2 to 3%. That's not material, but may create some mismatches. As far as covered call strategy, JEPQ sells out-of-the-money calls on Nasdaq 100. The fund ladders them weekly with 1-month expiration dates. JEPQ has rules when it comes to selecting strike price for options. Most of the time it's about 2 to 3% above the current Nasdaq 100 price. But when Nasdaq 100 is very volatile or down, JEPQ sells options at strike price even further out. And that's good. In other words, this approach gives JEPQ some breathing room to capture some upside. JEPQ packages its covered call positions in so-called equity-linked notes or ELNs. ELNs greatly simplify distribution classification for investors for tax purposes. But this comes at the expense that it's like an interest income and it gets taxed at a higher regular income tax rates. I will talk about taxation for these funds shortly. Before proceeding to QQQI and GPIQ, I want to address net asset value or NAV erosion risk. NAV erosion happens when a fund's net asset value per share starts to decline, and because NAV per share is typically equivalent to the fund's stock price, it means that the fund's stock price starts to decline when NAV erosion takes hold. NAV erosion happens because covered call funds must distribute their earnings to you by tax law, and in down markets these distributions may actually dip into your investment principal. Why is NAV erosion a bad thing? The reason is simple. If NAV erosion risk takes hold of the fund, its distribution may stagnate, or worse, they can even go down. And that's not particularly a good outcome in retirement if you rely on these distributions. Then in that case, you cannot keep all your distributions, and partial reinvestment becomes a must. If we look at JEPQ, its stock price is roughly up, and that's good, but it is still down since the April plunge episode. It will likely recover. But as we will see shortly, QQQI and GPIQ are doing a better job of managing their NAV erosion risk. Next monthly dividend ETF is QQQI by NEOS. This fund has similar goals as JEPQ, but differs when it comes to execution. QQQI targets a yield of about 14 to 15% and holds all Nasdaq 100 stocks. QQQI also sells call options on the index, typically the out-of-the-money ones. This leaves it some room for capturing price appreciation. But QQQI targets a much higher yield compared to the other two funds, and hence it has to sell more call options on its portfolio to generate more income, and the typical portfolio coverage could be around 70%. In other words, QQQI caps upside on as much as 70% of its portfolio. Most all call options will cap QQQI upside in bull markets. To mitigate this negative, the fund takes a very active approach when it comes to managing its covered call strategy. Also, the fund may sometimes even buy call options, and this will greatly enhance its upside potential, as well as mitigate its NAV erosion risk. For instance, since April, QQQI is up and recovered in its stock price. Finally, we have another monthly dividend ETF by Goldman Sachs, GPIQ. GPIQ also replicates the entire Nasdaq 100 portfolio with a covered call strategy overlay for income. Its current yield stands at 10%. To generate this yield, GPIQ goes heavy on selling call options on its benchmark. In fact, its sold call options may cover up to 75% of its portfolio. Unlike the other two funds, GPIQ focuses on at-the-money call options. These call options tend to generate more premium income. But sold at-the-money call options come with higher caps on upside, and that's a big negative. But the beauty of this fund is that it doesn't have to sell call options on its entire portfolio. In fact, it does so dynamically. And depending on the market conditions, GPIQ may sell call options on as little as 25% of its portfolio. This percentage largely depends on the amount of volatility of Nasdaq 100. When the volatility goes up, the premium income on written covered calls positions is also up, and that means that GPIQ doesn't have to sell as much call options to generate a certain level of income. So what happens when GPIQ doesn't have to sell call options on 100% of its portfolio? Well, that allows it to capture lots of upside when Nasdaq 100 recovers and goes up, and that mitigates GPIQ NAV erosion risk big time over time. Because Nasdaq 100 tends to trend upwards long term, this is a sensible approach. GPIQ stock price recovered relatively fast from the April plunge. Again, this shows that Goldman Sachs did a fine job with this fund. Now let's compare the total returns of these three funds. Since 2024, GPIQ and QQQI have shown comparable returns. True, GPIQ has a lower yield compared to QQQI by almost 4%. But GPIQ does not go heavy on covered calls. For this reason, it captured more price appreciation from Nasdaq 100 than QQQI. If we zoom out to 2023, we see that GPIQ and JEPQ performed on par. But after the April plunge, GPIQ recovered faster and returns of the two funds diverged. And this will be generally true after each down and up cycle for JEPQ. Its total returns will lag behind GPIQ and QQQI even further. Based on my research, GPIQ and QQQI are new generations of covered call funds that address NAV erosion risk head-on, and with their active approach to managing call options, they capture more upside of Nasdaq 100 compared to JEPQ, and that is something to like. Why is it important? Because growing NAV per share over time will ensure that your distributions will not stagnate and will be more likely to grow over time. For instance, take GPIQ. It doesn't offer the highest yield of the three, but it shows better prospects of price appreciation. And for this reason, its yield on cost and distributions will be more likely to grow at a faster rate compared to the other two funds. Conversely, we have QQQI, which goes heavy on yield. And long-term, this fund is yet to show its upside or downside capture, but so far it did a fine job. I speculate that GPIQ will probably do a better job of capturing upside of Nasdaq 100, and the main reason is because it doesn't go for the highest yield and doesn't sell as much of call option volume on its portfolio. When we compare the standard deviations for these three funds, they are not too far from each other. Although GPIQ shows a slightly higher volatility of returns, but not materially so. So we see that covered call funds in question, they cap your upside, but they also expose you to Nasdaq 100 downside. So the question then becomes, should you just hold Nasdaq 100 and instead of relying on yield from covered call funds, just sell shares on as-needed basis? That's one common argument against these monthly covered call funds. For instance, let's assume 1% monthly withdrawal rate for all three funds. We see that an investor is still left with more money at the end with Nasdaq 100 for this particular period. One area where these funds will shine is in sideways markets. When Nasdaq 100 doesn't get pretty much anywhere and stays flat, these funds will keep their premium at pretty much no cost, and it's quite possible that they will even beat the Nasdaq 100 in those situations. But what if we enter a prolonged bear market? Well, in that case, the premiums that these funds generate will shield them a little bit from that downside. In other words, when Nasdaq 100 falls, these funds will fall by a little less. But make no mistake, these funds will fall. And my main concern with them is that they are yet to experience that prolonged bear market, given that they're a relative newcomers. Also, the consistency of distributions is far from assured for these funds under the bear market scenario. When Nasdaq 100 falls, so will the stock price for these funds. And in that case, the capital per share available to these funds will shrink too, and so will distributions. And that's what we typically observe for other covered call funds. And I don't think that these three funds are any exception to this general observation. So when Nasdaq 100 falls and enters a prolonged bear market, you can expect that your distributions will decline too. On a final note, I want to address tax efficiency for these three funds. If you hold all these funds in tax-deferred accounts, it doesn't really matter, because anything that you withdraw will get taxed at your regular income tax rate. But holding these funds in a taxable account is a completely different matter. JEPQ is the least tax efficient of the three. The bulk of its distributions in taxable account will get taxed as a regular income at higher rates. But for GPIQ and QQQI, it's a different matter, because they trade so-called 1256 derivative contracts, and these contracts, they received a preferential tax treatment, meaning 60% of the premium distributions will get taxed as a long-term capital gain, while the remaining 40% is taxed as a short-term capital gain. And so potentially the holding of GPIQ and QQQI could be more tax efficient in taxable accounts compared to JEPQ. But there's one more thing about GPIQ and QQQI. Mainly, they often distribute so-called return of capital distributions. And return of capital distributions are not taxed. Instead, they reduce your cost basis first. And after your cost basis reaches zero, then all future premium income distributions will get taxed at that 60-40 split. For instance, in 2024, over 95% of all distributions from JEPQ were return of capital based on their 1099 tax form. For QQQI, it looks like 94% of their distributions were return of capital. GPIQ and QQQI did not experience a decline in their NAV per share in 2024. Thus, these returns of capital distributions were a good thing. Effectively, Uncle Sam lets you have this money tax-free until you sell your investments in GPIQ or QQQI. And even then, your tax-deferred distributions will be taxed as a long-term capital gain. So let's summarize and see how these three funds compare. When it comes to yield, QQQI has the highest one, but when it comes to NAV erosion risk, JEPQ lags behind the other two ETFs. This is largely due to how both GPIQ and QQQI capture more of Nasdaq 100 upside. With that comes a few consequences. Over time, both GPIQ and QQQI will show superior total returns. But not only that, their distributions will likely grow too. And that's something to like about them. In retirement, they are more likely to give you more bang for your buck. Finally, JEPQ is the less tax efficient if held in a taxable account. In conclusion, our cover call funds trade upside for income. So if the Nasdaq 100 continues trending up long term, these funds will lag behind it. But for someone in retirement, I can understand why these funds look so attractive. The yield alone is very high, and consistent cash flow, especially monthly cash flows, is an important consideration in retirement. But it is important to remember that Nasdaq 100 is a volatile and risky index, and our three funds do inherit that riskiness. Since 2022, Nasdaq 100 has been in almost non-interrupted uptrend, but prolonged corrections are almost certain to happen. If Nasdaq 100 enters bear territory, so will these three funds. They're equity-based funds after all. In bear markets, not only their stock price will decline, but also their distributions may suffer. And dividend consistency will also degrade, and your yield on cost may plunge. I know I'm probably talking about the worst case scenarios, but that's what retirement planning is about. I would definitely factor them in, and it is especially true and important if you are going to materially rely on these cover call funds in retirement. Very few asset classes are immune to bear markets, and even traditional dividend funds will see their payouts cut by double digits when times are bad. For cover call funds, their distribution choppiness and cuts will likely be even more pronounced. At the same time, Nasdaq 100 high volatility was beneficial for these funds. They produce higher distributions compared to some other funds that rely on, let's say, S&P 500 to generate their premium income. But if for some reason Nasdaq 100 enters a low volatility environment, the distributions for our funds will definitely suffer. The most important things with these cover call funds is to know what you're getting into. At least if you plan for different outcomes, you won't get those nasty surprises, and you know exactly why certain things play out a certain way. And that's all for this video. Stay tuned for more ETF reviews. In my next video, I will look at ULTY and some other popular cover call ETFs. If you enjoyed this video, give it a like and subscribe to my channel for more insights on investing. I will see you next time, and all the best.